Hello and welcome back to Market Lens. We hope everyone enjoyed the exciting Super Bowl, and we wanted to wish everyone a happy Valentine's Day. I'm Sam Rozzi, and I'm joined by American Portfolio's Chief Investment Officer, Cliff Walsh. If you're looking to catch up on any previous Market Lens episodes, you can find them on YouTube or in the Studio 454 video library. With some interesting weather over the weekend, it's still pretty chilly here in New York, so let's dive directly into this news or noise segment. There's been big divergences in high-yield bonds and equity returns. Typically, these are very highly correlated in normal economic times. Do you think this is news or noise?
I think it's news. It doesn't happen very often, so when it does, I think it deserves a closer look. Now, the bond market isn't always right. In fact, I think right now they've probably overdone what's being factored into the current rate forecast. I mean, we're looking at, 6, 7, 8, hikes over the next year and a half to 2 years. I think that's a little bit too much. We can get into the inflation argument if you want, but I think bond markets are typically smarter than the equity markets, especially during key moments. I think the old adage, credit anticipates and equities confirmed, is the right way to look at this here.
Okay, do you have some key examples from history where we've seen similar levels of divergence between spreads and equity returns?
Yeah, we can look at some key moments. I think, let's look at similar ones to where we're at now, which is a Fed tightening cycle. If you look back to the Q4 of 2014, under Janet Yellen, we saw a big divergence with high yield leading the way down. Equities followed. Same thing happened again in the Q4 of 2017, again under Yellen. We saw a balance sheet normalization. High yield led the way down. Equities followed again. Now, these were market corrections. They weren't huge pullbacks. They weren't, recessions, but they were, significant.
Yeah, so you think this is different?
I think it is. I think it's more difficult to pause with what we're seeing in the economy right now. Pullback is much more likely to happen and probably will be a little bit bigger. The balance sheet has been overextended. I mean, we saw roughly $5 trillion added to the Fed balance sheet in just the last 2 years, which is more than doubling. We've got inflation at 7.5%. Again, we think that's probably going to normalize significantly over the next couple of months, and even more so as we look to the back half of this year. But we have election at the end of this year in November, and you have a lot of people clamoring for somebody to do something about inflation. So I think you're going to see some hikes, and I think you're going to, I don't think we're going to get 50 basis points here in March, but I think you're going to see a consistent start to the cycle in March. And I think we're also starting with higher valuations, so the Fed feels like they can have the markets pull back and not need to support it.
Yeah, a lot of tough themes out there, high valuations, ballooning balance sheet, high levels of inflation. Let's stay on topic here, but zoom in a little onto corporate credit. So HYG, the high yield bond ETF, down about 5% year to date as of last Friday. There's massive put exposure out there in the options market, and it seems to be growing. How do you think this plays out?
Well, we have seen consistent outflows in high yield to start the year. I think it's been about $11 billion through the beginning of February. You've also seen, significant flows into equities, more recently in February. So definitely that divergence is playing out with actual dollars, being spent or pulled. We have seen, an increased activity in credit default swaps, credit options, as you mentioned. But I think this, divergence creates opportunities. I think the opportunity is to de-risk from equities at this point. There's a couple of reasons. One, hedge funds, multi-asset players like us at 9 points, we're going to rejigger based on risk reward. We see, a big divergence in high yield and the risk reward there versus what equities can offer us. We're going to make the move, and so will others. You also have pension funds that are going to rebalance at the end of this quarter. If equities hold up where they're at, their high yield exposure is going to be, and even their long duration exposure is going to be down significantly relative to equities. So you're going to see some buying there. And I think when you look at, just generally speaking, what the markets are factoring in, investment grade corporates, high yield corporates, long duration, all factoring in significant Fed moves. Probably too much, as I mentioned, but equities aren't factoring in enough. So I think that divergence just creates, opportunities to find better places to move your money.
Okay, so how far is the equity market right now from fully factoring in the potential rate hikes? Do you think there's still significant divergence between equity markets and bond markets there?
I do. Look, I think that the S&P is factoring in some sort of hike cycle here. but not as aggressive as the bond market is. Look, that's what happens when you have different participants, right? You have different analysts, different managers who are focused solely on what they do. Yeah, there are multi-asset players like ourselves, but there's a lot that, players that just focus on their one area. That's what I think we're seeing right now. So I think the S&P is factoring in some, but I think it's significantly away from where the bond market is, and I think you probably see another 15% if we are going to end up factoring in 6, 7, or 8 hikes. I think that's where the S&P has to go. So I think that's also straight up, kind of off the mark relative to the bond market. That's not including forecasting any sort of recession here or anything like that. If we were to see, a more aggressive Fed, get 8 hikes, I think we definitely see a recession. I think you would see, much more downside, especially given how much multiple expansion we've seen over these last 2 years.
Okay, and what if bonds are wrong here?
I think bonds will rally up and down the curve, especially at the long duration end. I think you'll definitely see equities, move up slightly. But I think on a relative basis, at least in the short term, you're going to see them underperform relative to bonds because they have not factored in, the 6 or 7 hikes. So you would think that when the market goes back the other way, then bonds would be the one to, to react back to the norm.
Yeah. I'm going to put my contrarian hat on here. In what world does the market run to the upside and we see double-digit type growth from equities from these levels here?
I just don't see that happening. I could rack my brain for a long time and not figure out what the drivers would be of something like that. I think you have so much in terms of headwinds, from the Fed coming, even if they only hike 3 or 4 times, still significant headwinds. You've already started to see some cracks in, home building and existing home sales, and I think, the economy just can't handle, that type of, Fed tightening cycle, because you already have the Fed balance sheet, coming down, and that's also tightening. On top of which, if you look at what drove the markets from the bottom in March of 2020, it was 80% was multiple expansion, right? Typically, it's the other way in terms of earnings, growth versus multiple expansion. So we have it almost flip-flopped, and I think we're at multiples that just can't support another runaway year in the equity markets.
Yeah, and with the Fed saying they're going to hike 6, 7, 8 times, the last time in 2018, that never really ended up happening. So do you think that is the catalyst? Do you think the Fed hikes too aggressively and really hikes our economy into a recession here?
If you listen to the Fed presidents talk, some of them are saying we have to hike a certain number of times regardless of what we see. Others, want to be a little bit more cautious and hike once or twice and see how the data plays out. I do think that we are going to see inflation normalize a little bit in April, and you have those kind of more normal year-over-year comparisons happen. So we see a big downtick in inflation. That could be the cause for them to maybe pull back on the reins a little bit and not go 6, 7, 8 times. But the risk is definitely if they tighten too quickly, do 50 basis points here, do 50 basis points in July, that's going to be a problem because I think the market the markets can't handle it, but certainly the economy won't be able to handle it either. And I think it's possible we have a recession even with 4 hikes, but 6, 7, 8, is going to be a significant catalyst to the downside with this economy.
Yeah, I would love to take out my crystal ball and see what equities look like if we hike 8 times. So thank you, Cliff, for your insight. This was great. I'd also like to mention registration is now open for Connections 2022. Our national conference is back in person at Mohegan Sun in Connecticut, May 18th through 20th. We'd love to see you there. So to register, please register at connections8p.com. Thank you very much, and we hope this is letting you see 2020. Take care.